In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Welcome back to all of our Market Rebels. And Stu, if I see this correctly on my calendar here, I think this is our last Coach's Corner of the year.
It is. Our next two sessions, I believe, fall on Christmas and New Year's. So
unbelievable. So we do have a special New Year's resolution for everybody, but I think it's going to be on the 8th, somewhere in there. So it'll be just a touch after New Year's. But this is our last one. I can't believe it.
You know what happens, Bill? As you get older, time just flies faster as you're having more fun.
It does fly.
That's what it is.
So we have a very special one for you today, and it's a little bit of a sneak peek at a very, very small slice of what Stu and I will be talking about in Miami on the 29th and 30th. We have I think it's about a day and a half, just us interacting with the crowd, doing trading simulations. But what we want to do is to show people how markets really work and how you can get yourself in trouble by following the advice of what you typically hear on YouTube. And this is a very specific case of that. So let's get started. This is going to be a really fun one here. I think new for a lot of people. Let's start off with our Chalk Talk question. A stock's price is the market's view of value. We could also say an options price, but most people hear, well, you know, the stock's trading at 100. That's the consensus view of the value. And what we want you to do is to think about that. Is that true or is it false? You know, kind of thinking everybody's out here putting bids and offers in. It's a consensus view, kind of an average. What do you think? So think about that. We'll come back and answer it. And so for today, we're going to be talking about who controls the quotes.
Bill, you know, I just thought of something.
Yeah.
When Bill and I talk about the YouTubers, you know, we use it as kind of a facetious, funny, you know, term.
The people who think that
there are plenty of people out there that happen to be on YouTube that are well qualified, and what we're really saying underneath our facetious statement is be careful about, you know, look at credentials, look at who it is that you're listening to.
Right?
Do they have a background? Do they have experience? Do they have an educational background? Who are they? Where do they come from?
Right.
Did they just pop out of the dirt somewhere and all of a sudden they got lucky on a couple trades? Or is it someone who can really talk the talk and walk the walk?
Right. And I'm glad you brought that up because there are a lot of really highly qualified ones out there. But for the most part, you hear people that are just talking about nonsensical stuff, and it seems to make sense to a lot of people. So the question that we have here, who controls the quotes? Now, what do you think that most people are going to say? The market makers, right? It's the market makers that control the quotes. And we're going to show you. Now, we're not saying that they can't influence quotes, or they might be the high bid and the low offer. but it's a much deeper, much more delicate question than what it might appear. And once you understand this, you're going to see why a lot of the strategies that people tell you are just not real good. So, quick plug for everybody who's looking for more education out there. Check it out right there on the screen, marketrebellion.com/get started. All kinds of articles and videos to help you get a very good foundation for options trading. It is absolutely critical. So, our start today, Stu, something you are really familiar with, is the limit order book. And we're going to start, I would say that this is going to be a foundational piece of the entire presentation in Miami. And it's going to show that once you understand how quotes work, which is really what we're after, how are prices formed? How do they change? Why do they change? Everything else starts to fall into place. And we're going to have all kinds of trading sims and interesting spin-off ideas. But I would say this is one of the central ideas. Now, sometimes people say, why do we want to know what a limit order book is? Who cares? I want to see what's happening on my chart. I want to watch the candlesticks. Well, guess where those candlesticks are coming from? The candlesticks are reflections of the limit order book. So do you want to have a better understanding of shadows or a better understanding of the process?
Bill, are you trying to suggest that the markets that you see on the screen aren't just kind of made up some numbers from some wizard behind the that
That's how
curtain in the
everybody
Wizard of
thinks.
Oz?
Right. There's us, the retail traders, and then there's the market makers, and we have to either buy from the market makers or we have to sell to the market makers, and they control all the quotes. You're going to see that as absolute nonsense.
Yeah.
But once you understand how this is formed, you're going to see interesting strategies. But more importantly, we're going to show you one special case, why it can be really dangerous to follow some of the rules that some people talk about. So the limit order book, what is this thing? Well, financial markets are driven by a limit order book, sometimes called an LOB. You'll see that a lot in finance. And what it is, it's just a listing, a computer program, and it's showing all of the buy limits, and it's the highest price where a trade can be executed. Okay, so we're looking for our buy limits. I'm willing to buy a stock for a certain price. And we want to know who is the highest bidder, who's willing to pay the most. And it's going to have a sell limit, right? You're all familiar with limit orders. Buy the stock at a limit of, that's what we're talking about, or sell it at a limit of. That's why it's called a limit order book. It is strictly plugging in it's following all of these limits. So the sell is the lowest price where a trade can be executed. You might be thinking, well, what about the lowest price where we can buy it? Markets are not interested in who's willing to pay the least. The action is who's willing to pay the most, just like eBay. Right? Anybody can come up and say, Stu, I'll give you $1 for your shares of Microsoft. Anybody can say that. I'll give you $2. Why would we be worried about them? We want to know who's the highest bidder. And likewise, somebody could say, I'll sell you my Microsoft shares for $10,000 a share. And there's probably some people out there who think that that's what they're worth. Markets aren't worth or not interested in listening to those quotes, at least not yet. We want to know who is the lowest seller. And so the limit order book is simply a listing. It's going to list all of these prices or all of these quotes according to price and time. It's called a price priority and a time priority. And once you understand the limit order book, you're going to see a very different side of markets that never understood before.
Here's a quick example of this, sir. But you know what? Keep going. I'll push this in a little bit later. Go ahead. Keep going.
Okay. Now, many of you probably have seen on Tasty Trade, Thinkorswim, you can E-Trade. They have a level 2, and that's what we're looking at here. Now, Stu, when he was a market maker, had a level 3, which means you could actually enter orders into there at different positions, and that's going to be important what we're talking about in Miami. But for right now, we're just going to see how this limit order book gets formed. So to make it easy, we're going to just assume that this is our computer screen and we have nothing in here. Now, of course, this is very unrealistic. They have lots of orders through the night, lots of orders carried over from yesterday and all the time in the past. So let's say when Stu would log in the morning, these things are going to be chock full of numbers. But that's a little hard to say, where do these numbers come from?
So we're going to pretend that this is maybe a brand new listing. We have no bids or offers. All right, so here's our limit order book.
Which does happen. Kind of every time
It does. That is true.
every time there's a new like an
That's right.
IPO, the
IPOs, yep.
the markets have to start somewhere.
That's right. And we're going to talk about that in Miami and why that can be either severely underbid or severely overbid. And that's why you have to be careful. We're going to show it's really going to be, we're going to have so much fun. We're going to look at informed traders versus noise traders. We're going to look at Schelling points and Nash equilibriums and all of the things that you really need to understand how these prices get formed. So here we go. Our first order just came in. Stu, we have an order to buy 5. Let's say this is a particular option, you know, the May hundreds, whatever. I just, for clarity, I kept all of that out, but it's a specific asset. It's either Microsoft or it's the Microsoft May whatever.
Yeah.
It's a specific option. So let's say that these are options. Somebody comes in to buy 5, we'll make them call options. To buy 5 at a limit of 346. All right. So again, you would go on your broker's platform, buy 5, limit order 3.46. That's how that got here. Now, where did it come from? Don't know. I don't know where it came from. It's some broker somewhere funneled this into the exchange. So what Stu's computer book is going to do is it's going to recognize that this is a buyer. Buyers place bids. So the computer is going to line that up over here under the bids. Now another order comes in, buy 1 contract at 336. And I'm sorry, I've changed the format here. I missed this one. It should be 2 in the parentheses. So it is a buy of 2. All right, now notice something here, that 336 is not as strong. We call this a weaker buyer. We can't just ignore them. It's on the books. But why did we list them underneath? Well, remember, the markets are interested in who's willing to pay the most. These are buyers. So this guy's going to get listed, but we're going to shove him down here underneath. Another order comes in. This is going to be, and again, that should be sell at 308 for 2 contracts. Now, sellers place offers. All right, so think if you are selling your house, we're saying we are offering, or this is what a seller is. Now, I know it gets confusing because in the housing market, they say we're
it's back. They do it backwards.
They do it backwards. I know. They say we're putting in an offer.
But they think we do it backwards. So.
Well, I guess that's all relative, right? But just remember that sellers place offers.
Yeah.
So now we have another order to come in. And again, that should be sell 10 at 322. Now it's a seller, so it goes over here. Now, why does this seller get put below? We put the high bidder over here. Why do we put the higher offer over here? Well, I just said that the market's only interested in who is willing to pay the most, high bid, or sell for the least. So this is now, it's a stronger offer, but we're interested in the weaker offers, the lower numbers. So that's why we're stacking these in what appears to be in reverse order, because they are in reverse order. So another trade comes in to buy, and again, that should be limit of 342 for 7. So this guy gets stacked. Now, notice what happened here. He's stronger than 336, but not as strong as 346. So that's why it's called price priority. Notice it does not matter how many contracts you have. It is strictly price, who's the highest, for the bids, who's the highest. All right, so now we have a seller at 316 for 1 contract. Where do you suppose he's going to go, Stu? Markets are only interested in lowest offers, so we're going to shove him right in between. All right, so now you can kind of see the pattern. Buy at 350. Ooh, where do you think this guy's going to go? What do all of you think? High bid or low bid? He's the highest bidder, so he should go where? Front of the line. Price priority. We have another order that comes in from somewhere. Again, we have no idea where. It's to sell 3 contracts at 302. Where's this guy going to go? Looks like the lowest number to me. He's going to go over here.
Yeah, think of it like any auction, everyone. Any auction. Could be a car auction, could be an art auction, could be an antique auction, could be, whatever. It's an auction. Like highest bidder wins the prize.
The highest bidder.
If this is crucial, right? If the seller is willing to sell at
Sell
that
at that
price,
price.
right? Anybody ever hear of a reserve? Oh,
Yeah, like
that
for eBay,
Ferrari
exactly.
has a reserve of $1 million. Well, the highest bidder is 800. Well, there
Not
you go.
happening.
There's your market, right? I
Yep.
mean, there's no trade.
No trade. So now to clarify, what is time priority? We just talked about price priority, which is what we're seeing here, highest bids, lowest offers. But what is time priority? Well, it's a second labeling of the way the limit order book works. And let's say that somebody comes in with 346 for 3 contracts. Now notice we've already got a bid of 346. So would it be fair to put this guy in front and let him get filled first? This guy was
No,
here first.
no.
So what the markets are going to do is they're going to say, all right, or the computer, they're going to say, hey, I've noticed we have 2 of them here at the same price. So what we're going to do is we're just going to aggregate them. We have 8 contracts total. So we're going to show it on our limit order book as 346 for 8. But notice that's not one particular trader. When you're looking at that on your screen, if you're looking at the level 2, it might be 1 trader, might be 8 traders. We don't know. It's just 8 contracts. But what the computer's going to do on the limit order book, it's now going to put these over here and say this guy came in at 10:06 and 22 seconds. This guy was 10:07:13.
Right.
It's time priority.
Right. So if you ever have an issue with the trade that you thought should have been filled because
There you go.
you're
Yep.
watching your time and sales and you see the 346 trade go off, but you
How
didn't
come I
get it
didn't get
filled,
filled?
you
Right.
call your broker and you say, I want to know, I want to see the timestamps of the orders that came in, and I want you to show me that my timestamp was after the
Yep.
former one that did trade, which
Yep.
is, why am I not getting a fill? That's your question.
Exactly. So this is the limit order book, and as you can imagine, these are fast and furious. There's just tons of them. These numbers are probably going to be very big, and at least in a liquid market. But you get the idea.
Bill, you think a lot of people know about that kind of stuff?
I think most people don't. Now, you and I come from broker, in your case, floor trading, but we would see things like this, and it's like you say, a lot of times we have requests for time and sales, and to get prints. And by
No,
the way, if you
I
are
don't say
looking for
that.
that, you
I
can.
don't say that to like be, I don't say that to pat ourselves on the
No,
ass. I
it's
say
just
that because there are workarounds. Right.
there are.
If you're on your level 2 and you see a fairly sizable, because they give you sizes like Bill, like the 8,
That's right.
Bill put up there that 8, that's made up of 5 and 3. If you see a big number and you want to bid 346, maybe you want to jump in front of that. Maybe
Yeah.
you want to bid 347 and
Yeah,
you'll be the only one
exactly. See,
bidding.
now you pass the entire line by for
That's
one
right.
penny.
Right.
Yep,
For what? For a penny?
for a
Do you
penny.
really care?
See, that's a really good point about understanding the limit order book. Because some people say, well, maybe I'll go at 346. Yeah, but what if there's 100 orders down here? What if this depth is 1,000? And now you're seeing orders going off. Well, how come it went off at 346 and I didn't get filled? Well, somebody bought or sold for 5. See, that's where it becomes confusing. Like this guy down here might say, hey, I just saw it trade at 346. How come I didn't get filled? Well, that was for 5 contracts. That went to
That's
this
right.
guy.
Right.
Now,
Now
what if this guy somebody did a sell for 7 contracts? This guy would get 5, this would get 2. It's called a partial fill, and he would show 1 that still remains open.
right.
That's why that happens on if you've ever seen, I'm sure everybody does.
You
It
don't get
happens all
filled
the
on
time.
all of them, right?
Correct.
Yeah.
But this is why. It's people think, oh, it traded at 346. Everybody who wanted to trade in the world at that price could trade. No, these are auctions. There's just like on eBay, it'll say 1 available, 5 available. You can't say, all right, send me 20 of them. There's only 5. Same thing
And
here. And this eludes a lot of people of how markets work.
now here's a really important little nuance here. So you might say, okay, well, I heard this dude Stu on TV or whatever this is, YouTube, talking about this. I bid 347, and I was the first one up there, and everybody joined me. Now it's 347 bid. Now it's 348 bid, and now it's 347. See, the markets are moving right now. It's 347 bid, but I know because I didn't cancel my order that I'm actually the first one in there. because that was the timestamp. Remember we talked about that?
Yep,
And
trade
but
crews.
now you got like a lot, maybe thousands or hundreds of people bidding with you, orders or for contracts bidding with you. And now
Yep.
all of a sudden, that number starts going down. Right. So there was like 500 bid for it. Now there's 300 bid for it. Now there's 200 bid for it. You're out there trying to buy your 10 lot. Now there's 10 bid for it. You're the only one. And you're thinking like, wow, I'm going to buy these. And guess what? You are going to buy them. Why are you going to buy them?
Because the stock
nobody
is
else wants. Because the stock is tanking,
the
right?
stock is
You think
tanking.
you're- Oh my God, I got to fill. Really? You just got ran over. You got picked off, and you provided liquidity for an informed trader. And you, Bill's laughing at me. And you're the guy that
we
just,
just
you know,
think
you're
too
the
much
sitting
alike. That's
duck.
exactly where I wanted to go with this. Exactly. People don't realize that. They go, oh, look, the high bid is, let me go at 346, or let me go at 342, because I'm gonna muscle my way in here with the I'm gonna negotiate with the market maker. No, you're not. You're just finding a lower place in the limit order book. And as we're gonna talk about in Miami, when you understand how this works and Schelling points and Nash equilibriums and pockets where we can get liquidity pockets, you're going to actually end up being liquidity providers at exactly the wrong time.
Exactly. Yeah.
Yeah.
You
And
just
people
got
don't
ran
understand that. They go, oh, great, yeah, you got filled because you were a liquidity pocket
You
for
were sitting
somebody.
duck, and people say, "Oh, that's okay," but I got filled. Yeah, but look, it adds up, man. You know, it's
Oh,
real
yeah.
money, right? You're
Well, the
getting filled at
irony
a
is, too,
price
in your
that
example, the irony is I want to get filled at 342 because it's bidding 350, and I'm going to get I'm going to get an 8-cent discount. You're all happy and patting yourself on the back that you got 342 and it's now bidding 290.
yeah.
See,
And you
that's
know
the
what? I was going to say that's what I was going to say before, right? Somebody says, you know, look, you're in some chat room, and they say, "Well, we're going to bid 350 for these options."
Mhm.
That's what the stock at a certain price, and right, you go in, you get
Yep.
350, and maybe, and you know, maybe you don't see it, or maybe you just went to get a cup of coffee and you came back, and now they're trading at 310, and you go in, you buy them at 310, and then you get in there and you say, "Oh man, I got to buy these at a discount." Really?
Yeah,
Yeah, there's
exactly. We hear so much of this. It's just not
no discount
understanding.
there, man. The stock went down.
It's not understanding how markets work. Correct. So anyway, once you get this for kind of a good mental model, you'll understand where these numbers are coming from. Now, let's take a next step. Before we do, you know where to go, marketrebellion.com/get started. More topics just like this, articles, videos to help you get a firm foundation. So now let's answer the question, who determines price? Now, if you ask most of the people out there, they're going to say it's the market makers. Well, the prices are determined by the market, not the market
The
maker.
market
The
makers.
market maker is a participant, and the quotes you see might be it might be only the bid, might only be the offer, might be both, might be neither. If it's a very liquid market and it's humming along, market maker might just be sitting
Might
on
be
the
neither.
side. Could be. So you don't really know who's making those
Might be.
quotes. The market makers balance supply and demand. That's primarily. Nor does it matter. Correct.
Nor does it matter.
Doesn't even matter.
It doesn't matter who's making it. See, if you know how options are priced and what levels you are interested in via implied volatility, you know, intrinsic, extrinsic, all that delta, right? You don't really care who's making the market. If you can buy or sell something at the price that you, not the market, determines is advantageous to you,
Right.
then that's the game.
Then that's the game. So the thing is that there are a small group of traders responsible for the price. Notice I said small group, and that group could include you. And I don't mean you, Stu. I mean you out there watching on YouTube or wherever you happen to be. It could be me. It could be Stu. All of us could be this small group of traders that are responsible for the prices that you see on the quote board. And we're going to look at why that is in a moment. But these are called, at least in the academic world, called the marginal pairs. There's 2 pairs or 4 traders total. This is fascinating. 4 traders who are responsible for those quotes. And it's the level where we reach the first failed cross.
Well,
What does
4
that mean?
markets. That the market can be made up of multiple players, but 4 markets that are responsible. 4 bids and offers, 4 numbers.
Right.
of bids and offers.
And we're going to see why that is in a moment. Now, this is where we reached the first failed cross. Now, Stu and I are going to be doing live simulations in Miami where you can actually place bids and offers on your phone. Stu's gonna be our market maker. And Stu, do you have experience doing that?
Couple of months, yeah.
He was a market maker and specialist for 29 years. So he's going to show us, but while you're out there bidding, we're going to make markets in some simple ideas. We're going to move to so that people understand it. Then we're going to look at under no information, perfect information, informed traders, what happens, news, how do bubbles form, how do they crash, and you're going to see why it happens. But anyway, this idea of marginal pairs, it's where we get the first failed cross. It doesn't make a lot of sense now, but it's where the bid is less than or equal to the ask.
Mm-hmm.
So let's go back to our quotes. So Stu's sitting here. Remember, all these numbers came in, have no idea where they came from, nor does it matter. So if Stu was doing this by hand, which I guess way back in the day was probably before computers, how it was done.
We did.
Yep. But this is what the computers do now. They say, all right, where do we open the market? Do we want to open it at a high bid of 350? Or where do we do it? Well, we want to get most of these trades cleared. So notice what we're going to do. This is why we stack them in these reverse orders. This guy's willing to pay 350. This guy's willing to sell for 302. We can cross those. The bid is greater than the offer.
Just put them together. Just put them together.
Just put them together.
Question
346
is at what price?
is greater than 308. Keep going. 342 is greater than 316. 336 greater than 322. Getting closer. 330 is greater than 328. 324 is less than 334. So what we're going to do is we're going to mark those. Those are the first two that we have a failed cross where the bid was less than or less than the offer.
Yep.
And then we have, these are the marginal pairs where we had the weakest bidder, right? 330 was matched with the strongest offer, at least in this pair right here. So those four people are the marginal pairs. Though when you look at your quotes, it is four people who are responsible for that number. So what happens is that the market that the limit order book is down here, all of these guys up here clear. Right, they're gone. So where are we going to open? Yeah, maybe 329, somewhere between 324 and 334. So see, these guys are just gone. They're not part of the market. So there's now you look at, and I should have clarified, Stu might print the opening trade at 329, and what that does is it clears out all of these in green. And when you at home, me at home, Stu at home, retail traders, when we log on and you see 324 offered at 334, where are those numbers coming from? It's the high bid and the low offer from the limit order book.
Whatever's left over.
That's there's your quotes right there. Now, does this mean that your little quiz for you, does that mean that you can come in here and sell 500 contracts because I see a bid of 324? Nope. There's only so many, and your platforms will show you how many.
Yeah, you can if there's 500 bid for it, but if there's 200
or more, correct?
Right. you can't sell them. And if you go to sell 500 at 324 and there's 200 bid for, there's a chance that 500 might trade. 300 might step up to the plate to grab
them. Market maker might come and say, you know what, I'll take the remainder. Yep.
Yeah.
So now what's our midpoint here? 329. Now this is another fallacy that people hear. Well, why didn't my trade go off, Stu? Because I've got an order for 329.
Yeah.
Well, for all of you out there watching, tell me who is bidding 329 and who's offering at 329.
I don't see anybody offering their bid.
Nobody. That's why your order's not filling. Now, in fairness, if you put in a bid at 329, you will become the high bidder. You're going to bump this guy down, right? You're the high bidder, and you are giving somebody an incentive to sell to you. And if you fill, that's why you filled, not because you negotiated with the market maker. You were just the high bidder. So again, it starts to reveal some of these fallacies. But you kind of alluded to this a moment ago, Stu, and these are some of the traps we're going to show from in our demonstrations. There's a thing called walking the book. I'm going to show where this typically happens. And it can, without market makers, traders may end up walking the book. Everybody thinks market makers are the bad guys. Let me show you where the bad guys really live. If you have no market makers, what's going to happen? And this can be dangerous with volatile stocks or low liquidity. Things like penny stocks, and I've seen this happen to horrific levels. We had one guy that was bidding like a buck and a half, and highest fill was at 350. So, and it's called walking the book. So here's what happens. Let's go back to our limit order book. Remember, these guys clear. It's where the highest bid, we were matching all the areas where the highest bid was greater than the corresponding offer. So they're all gone. Our opening quote is 324.34. And by the way, people have always asked us, what do you mean it's offered at $34? No, for speed, if they have the same dollar, we just quote the cents because we know it's 3 something. Right? So Stu and I would say it's 324.34. And actually, if Stu were a client and he's like, what's it doing now? We already have established it's 3. I'd say it's 24.34.
Yeah, absolutely.
It's now 23.32. It's he knows it's 3 something.
Yeah,
but
we
it's
already
for-
know that it's the 3 handle, so it's
It's
just
a 3 correct. So it's 324.34 is the quote. That's our open. And now let's say that somebody comes in and does a buys at 334. Well, how did you get filled? You lifted the offer. You picked
somebody
this guy
sold
off.
it to you.
So this
Yeah.
guy says, "Yay, I got filled. What's the new quote now? 324.42. The spread just got widened. So how did the spread widen? Oh, the market makers ripped me off. No, somebody just picked off the offer.
Which might have been you.
Which you might have been exactly. You might have been the one that widened it.
Yeah.
Market maker might have come in between that and actually narrowed it, but it was still wider than this 10-cent quote. But
Yeah.
it was your trade that actually widened it, and
Which
the market
might,
maker.
absolutely might be the case in that example that I was given before, where
Uh-huh.
you're out there bidding whatever that was, 350, and now the market coming out is like 320, 350, or 320, 340.
Yep. So you can see 324.42. The market maker steps in and goes, "I'll go 36." And what you see is, wow, the market went 324, 336. That market maker ripped me off. Nope, the market maker tightened it from 42 to 36. See, it's so easy to fall into these traps, and that's why all of these myths persist out there, because we think we can see what's happening with our eyes. You have to understand what's going on with the limit order book. So this is called, again, back to our story of walking the book. If there were no market makers, our quote's now 324.42. Somebody comes in to buy and lifts this offer. What's our quote now? 324.44. What's the quote now? Somebody buys that one, 324.48. Somebody buys at 348. What's the quote now? 324.350. See, if there were no market makers, you would see these bid-ask spreads just go off into ridiculous levels. And yet people think that it's the market makers that are doing this. It's not. It's you and me that are picking off these orders. Market makers, in most cases, are tightening them. Now, we're going to look at some very interesting cases when we get informed traders, when we have news, when we have rumors. We're going to look at different scenarios and how it affects the limit order book. But this is why one of the main reasons, one of the things we'll show is you have to be super careful when you hear stuff like, oh, look, I can look on my chart. I see that there's a strong flat line here, or there's the 50-day moving average. And because I'm a smart trader, I'm going to put my stop just below that. Well, guess what? That's what everybody knows that. And where do you think the algo bots are going to hunt for liquidity? Just below that stop. And they will put in trades to trigger that to make sure that they can buy at favorable prices when the prices rebuild. All you're doing is, it looks like you're executing trades, calling yourself a trader, and all you're doing is being liquidity for somebody who's more informed.
Liquidity providers, and you're not
You're
even
just
getting
being,
paid to be a
we call them liquidity
provider.
providers, which is a polite way of saying not a good trader. You're just becoming a liquidity provider for the people who are really making the money. They're going, hey, I'll just use you as my stop, or I'll use you as the more favorable buy order. because they also know where these points are. So again, those are just, again, it's some of the very few scratching the surface of what we're going to be talking about in Miami. We're so excited about this. We wanted to do this for a long time. But if this is new to you, it is really an invaluable lessons, because we're going to be up there for what, a day and a half, I think,
Yeah.
interacting with the crowd and making markets and explaining why, when you think that you're doing yourself a service about putting in stop orders at a certain level, that it might be the worst thing you could do. And why did the market blow right through my stop? It was the market maker. Well, no, it's because you didn't understand there was a big liquidity vacuum here, because that's where everybody was standing. And that's why people get the perceptions, because they see with their eyes. They go, well, I had a stop at 95 on this $100 stock, and I got filled at 87. The market maker ripped me off. No, you were standing where everybody else was. You got hit in a vacuum, and yours converts to a market order upon triggering or getting elected. If you don't understand that, these are the types of fills you're going to end up with. All right. So anyway, hopefully that gives you a little different look of where, when you see the candlesticks moving up and down, or you're on a minute chart and you're watching them dance along there, this is where they're coming from. You're just seeing the candlesticks are actually the shadows. The real activity is here. And when you understand the limit order book, why prices move, why people will bid higher, low offer, why they might find pockets in here, vacuums, again, Nash equilibriums are going to be a super fascinating topic. Why might a market maker keep a wide spread? And the novice traders go, oh, it's easy. I know to go inside that spread. Well, why do you think the market maker doesn't want to go inside that spread? Because they know there's an informed trader. And what just happened? You just sold that call for 3, and now the stock runs up 100 points. And they go, oh, the market maker knew it and I got ripped off. Nope, you didn't understand the limit order book. So it's a different way of looking at the markets. It's really a professional trader's way of understanding how markets are formed and why they can also backfire on you if you don't understand them. So with that, Stu, let's answer our question. A stock's price is the market's view, the consensus view of value. True or false? Absolutely false. It is 4 people that are responsible for that quote. If you changed any of those other numbers than those marginal pairs, you still get the same price. That's why we say they are the only 4 that are responsible for the price. So when you say, oh, look, this stock is trading for 100, everybody can buy and sell at 100. It might be 100 shares. You don't know. It's just those 4 quotes that we're dealing with. And when you understand that, you'll realize that sometimes these things that look like really good trades or really good ideas are extremely fragile. So we're going to have fun talking about that. That'll be on the 29th and 30th in Miami. If you're interested in joining us, we'd love to have you. Stu, any closing comments for our last Coach's Corner of the year? I can't believe it.
We do this, everyone, so you have a better understanding of how, like, what the mechanics are,
Right.
how these markets work, and it'll lead you to a spot where you can once you understand and how to navigate the markets
Correct.
for what they are, you'll get better pricing for yourself. And the 20 cents, 30 cents, the 15 cents, the dollars, sometimes, that adds up. It adds up.
Yeah.
It adds up to a ton of money.
Yeah.
And the better you understand how these things work and how not to get picked off and understand where the pricing is coming from, the better off you're going to be.
Well said. So we're going to have fun, and I know we'll see a lot of you in Miami. And I think we're also going to be doing a simulcast, I believe. So get with your sales agent, and you can find out how to get that done. But it's going to be a lot of fun. So it's sad. I can't believe it. It's the last Coach's Corner of the year. But the good news is we've got another quote. We're going to do a couple more of little taste tests of Miami. So we'll do that for our New Year's resolution. So we're looking forward to that. That'll be on January 8th. Have a great upcoming holiday, everyone. And we're looking forward to another fabulous year for 2026. And we'll see you then.
See everyone.